Hello and welcome to another webinar sponsored by Actio. Um, Today we're excited to talk about controls, right? So today we're going to talk about how to understand if your controls are truly mitigating your risks and why control self-assessment have so many challenges in implementing in organizations. For this talk, we invited John McLaughlin, a very experienced uh, uh, risk manager and consultant nowadays. Right, John? Welcome, John, to our
Yeah,
webinar.
thanks for having me back.
It's not the first time he shares his thoughts here and experience with us in our webinars. By the way, if you want to watch past webinars, we've covered so many topics, right? You can join our community in clicking in the link that is in the chat here. You'll be able to access the community. I guess they're still going to put the link up on the chat, but in the community, you'll find not only past webinars, but also uh, a community of peers where you can network, you can exchange experiences, benchmark your processes in your way of working with how other people are doing in other organizations, right? So that's a message I want to give. Join the community. It's always very rich. And also, please fill in the feedback form in the end, right? Where we want to hear you and how can we make this webinar better, right? So in the feedback, you also can mention if you want to receive a certificate of participation. If you fill in that checkbox, we will send you a certificate of participation here. So please help us with improving our webinars. Well, let's jump into it then. Today, we're going to talk to John. We're going to have a brief show of how control self-assessment can integrate with the whole ERM system through a demonstration of the software. Then we're going to come back to John for a few more questions and open for to answer your questions. So throughout the whole event, if you have any questions or comments, please put them in the chat. I'm going to be monitoring the chat here. And if we can address the questions that you put in throughout the event, we'll do so. If not, we're going to save some time in the end to get back to the questions that you put in the chat. So please interact. Please feel free to send us, all your comments, your viewpoints, and questions. All right. To start, I'd like to ask you guys a question just to get the temperature here of our audience, right? How confident are you that your current controls are actually reducing risk, not just ticking boxes? So on your teams, there should be a pop-up where you can answer how confident are you that your controls are actually reducing risk. Answers are starting to come in. Okay, so most of us are answering that we are uncertain. We don't have a clear way to measure this. So there are controls, but organizations are not having the measure of the effectiveness of these controls, right? Some people are fairly confident, and someone not confident at all. But we can say that 63% of the responses are uncertain. John, does this fit with your experience with all the organizations that you've been, interacting with in your consulting services and your past experience as executive?
So I'm not surprised by no one saying they're very confident, which is good because everyone gets surprised. The fact that, two people, the 25% had indicated that they're fairly confident, that also doesn't surprise me in that I think most people would feel fairly confident. To the individual who's not confident at all, obviously you're listening in and figuring out, all right, how do I solve this problem? So you're probably at the right place to get started because that's what we'll be talking about. And then the uncertainty is that you need a process, right, to be able to measure whether you have sufficient controls. And we'll get into this, but the prospect of having false positives, we think the controls are working, but they're not. So as we get into control self-assessment, I think we'll explore this uncertainty even greater.
Okay, let's dive into it then. How do you know if your controls are being truly effective, if they're actually mitigating risks?
So the way I look at that is that there's either mature entities or they're immature entities, or there's an environment related to internal controls that's immature, and there are those that are mature. And it seems like, and this can be in a very large organization or a small organization, but at from a philosophical level, those that are immature are where they look at controls as simply compliance obligations, and that they're a hindrance really to the speed that we need to operate as a company. Whereas a mature organization would say we have controls that help monitor our risks and help manage our risks, and that acceptance of the fact that you need controls. Just like a car needs brakes, you need controls in order to regulate how quickly you can get to from point A to point B. And so again, that view philosophically is control slow us down. They're a big pain in the you know what. Versus no, we need controls and help in order to be able to manage our risks. And then it becomes a risk alignment question. And the immature organization may say, well, this is just the way we've always done it. Versus a more mature organization would say, hey, look, what are we doing here from a controls perspective to help us achieve objectives and to manage the risks to achieving those objectives? So becoming more inquisitive as to what is the purpose of these controls and are they operating effectively? So this maturity, in terms of your level of maturity, doesn't matter whether you're a big organization or a small organization, it's more of a mindset.
And John, uh, uh, just a follow-up question on that. Um, Controls have costs, right? It can have actual cost, monetary cost. It can cost in time of your staff or time of your executives or um, just implementing the control, executing the control, analyzing the results of the control, right? All of this costs. Um, how can you start balancing like a cost return uh, on your controls, on how many controls you have, or how much effort you're gonna make on establishing and monitoring and executing controls.
Right,
How can
right.
you balance this off? Yeah.
Well, before I answer the balance question, is this question of the cost of controls and the benefit of that cost is almost fundamental to every CFO that I deal with. In the States, there's the Sarbanes-Oxley Compliance Act, where public companies And by the way, there are not-for-profits that have adopted the spirit of Sarbanes-Oxley because their boards have said we need to do this. But the cost involved in this is something that is really an irritant to the CFOs. And my reaction when speaking with someone new in this process is, yes, they are not deemed to be strategic. Controls are not strategic, but they're essential.
Mhm,
So you have to have controls in order to promote the reliability of your financial reporting, your
mhm.
operational reporting. You need internal controls in order to be able to have just more efficient and effective operations. So controls are very important. They're vital to an organization, but they may not be strategic. And so the cost of controls is hard to define as to like what is the benefit versus the cost until something goes wrong. And then the question is, well, the damage has been done. We need to rectify that damage. But, a more effective, these more mature organizations are saying, look, we need to evaluate our risks operationally as well as financial risks. And how are we mitigating those risks effectively and in the most efficient way? And evaluating those risks, then you then add resources to be able to control that risk. And so I find areas where companies have pretty elaborate controls around areas that do not present great risks, whereas they may not have sufficient controls in operational areas that may present significant risk.
Okay. So we're going to talk a bit more about control self-assessment, but I think this is a good point to ask why. Why some risks that are not that critical sometimes have, very elaborate controls, while other more critical risks don't have as much control. I feel it could have something to do with who is establishing that control, right? Is that true?
I think that is true. I mean, in performing the Sarbanes-Oxley work, but looking at it from the perspective of really being an ERM person, is that companies have pretty good controls around accounts payable processing, how they're spending money, how they regulate that, who's reviewing it, the accuracy and the completeness of that. And the same thing with payroll. But if you look at operational areas, uh, what was formative to me was I was involved with a daycare operator with a very large company. We owned the second largest daycare operator in the country. And the CEO of that business was new, and I was new to the organization as well as an audit director. And the CEO said, I'm very concerned about my controls around criminal background checks. This is with the daycare operator, 800 daycare facilities, maybe 900, all over the country. I'm concerned about criminal background checks. I'm concerned about drug checks. I'm concerned about van maintenance and safety checks on vans because you have little children riding around in these vans. And he said, what can I do about this? And the fact is, he was saying, you auditors are evaluating controls that are working, my payroll controls, even how I'm charging customers for tuition. But we're not evaluating how effective our background checks are. So these are operational controls. So it's easy for an accountant to evaluate and establish and test payroll controls and accounts payable controls. But it's not hard, but it takes time and energy to be able to evaluate criminal background check controls. So you have to understand the process, how it functions at a state level, a local level, and institute a program. And that's what we did. But the challenge is it's not familiar. And therefore, because it's not familiar, we're not spending enough time and energy on it to evaluate what are the controls to help mitigate risks in our most fundamental and important areas, like children's safety.
Okay. And in the beginning of your talk, you mentioned that controls can become just a compliance exercise, you know? So when does control assessment become a checkbox exercise? What happens that it goes that way, right? When it goes that way.
when it goes that way, right? So control self-assessment, and we'll get into this even more, is that that's also a vital activity, but where it becomes really less valuable to the organization is when people just simply accept what they're supposed to be testing from a control self-assessment standpoint. Was the invoice reviewed by a supervisor? Does it show the signature? It passes. Well, maybe should that item have been purchased in the first place? Did it extend beyond the purchasing authority of the individual who was making that purchase? And so control self-assessment, you can get into this rut of someone testing a control for simply what they call an attribute, an approval, but not understanding why have we designed this control to operate the way it is to mitigate risk. And so the trap that organizations sometimes get into, often enough, is that we have a control self-assessment program, but we're just really checking the box. Is that the individual, excuse me, who's checking the box doesn't understand the risk implications to the control that they're testing. And also looking at multiple controls that they may be that control self-assessor is evaluating and piecing together these five controls. Why are they important to this process? Why are they important to the organization? So control self-assessment, when done properly, is very important and it's valuable to an organization as like a preemptive mechanism to evaluate risks and to mitigate risks. But when it becomes a check the box, it's just a routine exercise that's not really mitigating risk.
So in control self-assessment, you should have critical thinking component to it, not just, okay, this control, that control, done, next task, right? And we know that getting people to think critically is not as easy as it seems, right?
Right?
Um, in your experience, have you seen models of control self-assessment that touch on that point, that ask people not to just, evaluate these controls, but um, instigate them to think critically about, are those the controls that should be looked at, and try to make people go down that path of thinking critically? Is that embedded in the control self-assessment, process? Have you seen this, or is it usually just, do this and get the task over with? What's your experience on that?
Well, my experience has been more like it's a burden. Let's do it. Did you evaluate your 15 transactions this month to look at those attributes? Did you get it done? Is not having a timeout every once in a while and comparing results across the control self-assessors. And my role, I'm a third party, so to the organizations, and therefore I'm the independent assessor. And when I come in and evaluate controls that were self-assessed, sometimes I'm finding different results.
Mhm.
And so there has to be a balance between the control self-assessor and, by the way, the competence of the control self-assessor, right? So the trap that I sometimes find is that let's get let's get Bobby. Bobby's not as busy as other people. Let's get him to test these controls, but Bobby may not really be the best candidate to be evaluating controls, you know, with that understanding and that philosophy that you're describing here to mitigate risk, to look at the bigger picture. And so It's something that's created. Control self-assessment's created. It's given to an individual who really doesn't have the intellectual horsepower to be performing these self-assessments to the betterment of the organization. And that individual may not actually be highly respected enough uh, for their viewpoints to be shared and welcomed and valued in that process too. It
And in
gets
that,
complicated.
it becomes a self-fulfilling prophecy, right? Because if you see it as a compliance exercise, you'll give it to whoever is available and not whoever should be actually looking and have the resources to critically analyze that. And once you give it to that person, it becomes a compliance exercise, and it stops having the aim of actually uh, analyzing and critically thinking about the controls, right?
But the internal audit profession has been talking about control self-assessment for at least 30 years. And it's a concept that's been out there. And I think what's critical now about control self-assessment is that every accounting function that I'm dealing with, and I'm generally dealing with the CFO, is that they're constrained more and more and more. More productivity is asked from them. More people are not being added to the finance functions to a large extent, yet the demands are greater. And so the demand for control self-assessment is even greater now, in that instituting a control self-assessment process that truly functions well is 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 paramount to the environment that many of my clients are operating in now because of those constraints of time, energy, money.
Okay. All right. Let's jump into a second survey so we can tap into the experience of our audience here. Um, in this second survey, would like to ask you, what does your organization currently use to measure control effectiveness? And then, due to a limitation of the survey tool here, we can't select more than one option. So I tried to make it like something that is cumulative. It's not 100% that way, we know in practice, but try the closest that you can get to your reality, right? So if you don't have any formal measure, first option there, you just have incident or near miss data. It's reactionary. You can select the second one. If you have near incident or near miss, plus external audit, the third, and so on. So for every option is all of the above, plus something else like control self-assessment or internal audit function. Let's see the answers coming in. Okay, so most are concentrated in having incident and near miss data plus external audit. We only have two people here that actually have control self-assessment plus an internal audit function. We know that we didn't give the option of having internal audit function without control self-assessment, but I mean, this is as close as we can get here. Again, John, does this match your experience?
Well, it's funny. The middle answer, the above, the near miss data and the external audit. I've been serving on the risk and audit committee of an organization for, I guess, a year and a half now. And it's a pretty complicated business. It's in healthcare. And and so the audit committee's view is, well, we have the external auditors looking at our controls. And these are all like very smart people on this committee. There's a handful of them. And what I've told them is you can't rely on the external auditors examination of internal controls to be thinking that this is a safe place to be. It's nice to hear what their views are on our processes and our controls, but that alone is not, in my mind, assurance enough that we have sufficient internal controls in our business. Yes, they look at payroll controls, they look at accounts payable controls, they look at how we're billing, but they're only getting a moderate amount of assurance for their internal audit. Whereas we, as owners of this business, I'm not an owner, but I'm a member of the board, but I have ownership feeling to it, is that we have to understand our controls and to ensure that they are properly mitigating our risks, right? So there's a change in that mindset. It's just not enough. But it's interesting that that was the, the most popular answer here.
Yeah, it fits with the exact experience that you said now, right? With having just external audit and not looking inside that much or using internal resources, right?
Right.
And that's all about what we're gonna talk next. That is diving deeper into control self-assessment and discussing this practice in more details, right? But before we get there, let's share a bit of how this can happen in practice in the software, how technology can support this this process, and then we come back and dive deep into control self-assessment. For this this part, I'll ask Eloise to join us and dive into the software and show a little bit of how this can happen in the day-to-day and how it connects to controls and to risks as a whole, right? Eloise, welcome.
Thank you, guys. I'm going to share my screen so we can have the navigation, understand how it works in a practical way. Can you guys see my screen?
Yes, we can.
Again.
Good. To understand the role of control self-assessment within the risk management process, we should first look at the risk being managed. So once the organization identify and assess the risk, it will define the controls intended to reduce its likelihood, its impact. So we should start, for example, with this view where we can have the metrics, where we can have the appetite, where we can see how are the assessments of the organization. We have here the inheritance risk, we have the residual risk, and the numbers of risk inside of each box. Also, we can see in the table view how the risks are, the degree, we can see the responsible, the area, and of course, we can understand how the risk is managed itself. So I just click on here on customer payment default, for example, this risk, where we can see the results of the last evaluation. We can see the score. We can see the score, the history of the score, the history of previous assessment of the risk. The tolerance is the risk appetite. If it's mitigate, sub-mitigate, out of control. We can understand the area responsible, the risk owner, the risk metrics related, and of course the description of the risk. What is this risk related to? So it is a threat, it is opportunity. What the type of the risk? Financial, image, legal, for example. We could understand the origin of this risk. We can understand, looking to the organization, the dictionary of risk. Where is related to? In this one here, for example, we have the main level of the dictionary, financial and credit risk. We have the second, counterparty credit risk, and the third one, the trade receivable credit risk. It's a very important view when we talk with the board, with directors, okay? And also, if there is a contingency plan related to this risk, so we have the basic for the risk to be created to understand how it works. After that, we can go deeper and make an analysis. So we start building, for example, the bow tie. It's a very powerful tool for risk assessment to understand the risk. So we have here the causes in the blue box and the consequence in the red one. And in the middle, we have the risk. But also we can understand the controls, okay, in these gray ones. Here we have the causes, we have the consequence, and we can also ask help for our AI, our artificial intelligence, to map those new causes, consequence, and controls related to this risk. And when we go to the controls itself here, we have a list of controls, okay? Controls that we register already in the system. And we can understand the control effectiveness, the type, the frequency that were agreed on the control self-assessment before, okay? Here, for example, we have the monitor averager payment term, okay? Where we can see basic information of the control. Who is the responsible, type of control, for example, do we have a frequency where we need to go back to the control and see how it's working? Do we have a type of evidence that we need to put together with this control to say, oh, it's really working? What's the evidence necessary, for example? And with this relation between the risk and control, we are going to generate the control review. Control review, we're going to be able to use this in the control self-assessment. But before going deeper in the control review, I want to show how this control was defined, okay? Because the control exists, but how it was decided, what was agreed on before. We have here, guys, the option to create the control self-assessment. Could be for new controls, for controls that already existed, and we need to make some updates, we need to make any change. In this case here, for example, we have basic information about the control self-assessment, we have the instructions. The CSA, for example, is designed to assess whether a control is appropriately designed, consistently performed, and supported by sufficient evidence. So here is like a conversation between the area, the internal control area, and the control owner, okay? In this case, I create this template. It's like some questions the owner of the control needs to answer, and then we can have a definition of important parameters, criteria, yeah, that we are going to use in the control. For example, is the control objective clearly defined? Do you know what to do? Does the control address a relevant cause of the risk? Could be yes, partially, could be no. Is really a discussion, guys. So the owner of the control can say, no, I have still some some questions about this control, how we're going to implement. Other important questions, how will the control be performed? Here he said, oh, there will be a financial team that will review the average payment term on a monthly basis, for example. Is the defined control frequency appropriate considering the level and nature of this risk? Remember the risk that we were talking about. Remember the position that we saw in the matrix. And this conversation is going to continue, okay? And after the owner of the control answer all of these how can I say, guys, these documents will go back to the area of the internal controls that will be able to make his own observations. For example, those here is for the other areas, for the internal control area. Is the control design appropriate to mitigate the identified risk? I'm answering this based on the answer of the owner of the control. Okay, a conversation. So, is the control ready for implementation? In this case, we are preparing a new control to use in the risk. And what about the recommended outcome, this final review? We can say, is design partially adequate? It's adequate, okay? Coming back to me as the internal control area, I can make the change here and I can change my final results. For example, I just said will be partially adequate, but after the new submission, the owner of the control could make the change necessary, and I can say, oh, now the design, now we have a final understanding of this control. Okay? And we can approve, we can return if we need more information about the control, but I can also say fail. But it's not our main goal, okay? Because we need this control. We need this break to the risk, okay? So we can approve, and after that, of course, we can also create some action plans. It means that sometimes, okay, we can have an understanding about how we're going to use this control, but there is could be some space for enhancements. For example, we can create action plans to define the calculation methodology when we're talking about effectiveness. How we're going to have the weight, the effectiveness of the control when applied to the specific risk. We can also establish some targets and acceptable thresholds, define responsibilities and escalation criteria, for example. So all this material, all this control self-assessment will be related to this control, to the control where I am the owner. Because when we have the control applied to the risk, as we saw before, going back here, where I have all of my risk, we call here mapped risk, okay? And now I know how I'm going to execute this control. That's why when I go back to risk analysis and I have the control here, in the control review, I know exactly the step I should follow. I know what is expected of me as the owner of the control. So I can say the control effectiveness, I can say if it's compliant or compliance, I can make comments because this effectiveness will impact my evaluation, my assessment of the risk, and depends on the type of the control. If it's preventive or is a corrective control, could impact where? Could impact here, yeah, in the causes or the consequence of the risk, in the likelihood or the impact of it. Okay? Make sense? Yeah.
Now, Louise, I have
Daniel.
a question. So what I thought was really interesting and helpful in this is that, yeah, where I've seen control self-assessment
Mm-hmm.
programs, is it's basically Excel based.
Mm-hmm.
It's that someone has a list of controls and they're responsible for testing these controls periodically. Is that there's no mechanism to have that tester, that control self-assessor, evaluate the control objective and define the control objective. And how does this control address the risk? I mean, you're having that person really think about what they're testing. And
Yeah.
so you may have so here's my question. The control self-assessor is providing this information related to that control that they're testing, who typically, excuse me, is evaluating those answers provided by that control self-assessor.
Yes, because it's like a conversation. We need a agreement in the end of the process. So even if I am the owner of the control, I need to explain if it is possible to do in a way that is health that I can do in the long time, but also should be in a way that we are going to mitigate the risk. So we have the support of the internal control areas because they have the methodology, they have the capacity to help the owner of the control of making the control in a way that is going to be very well executed in a better way, with the best practice. So it's not only him saying, the donor of control say, oh, of course I can do it. Will work. Will be
Right.
not that. Will be with the help, with the conversation.
So in a way, the control expert who might be an internal audit or might be the
Yeah, could
controller of the
be.
organization is
Yeah.
evaluating the quality of those answers or that information that's associated with each of these controls that's provided by the control owner.
Yes, exactly.
Right, right. That was interesting.
All right. Luis, thank you very much for your
Thank you.
insights.
Thanks,
I
Eloise.
know that you have a lot more to show here, but
Yes.
our focus is going to be mainly on the control self-assessment, right, for now.
Okay,
Thank you
thank you,
very much.
guys.
If you want to hang around and participate, feel free to hang around here and help us discuss control self-assessment. That's what we're gonna dive deeper into now, right? So, John, I'd like to ask you, like, why do control self-assessment results many times don't align with the audit findings? That's something that you mentioned in your first part of the talk. Why doesn't that happen? Why does that happen sometimes, right? The control self-assessment results not align with the audit findings.
But yeah, well, I think that's probably why this concept of control self-assessment has been discussed for, as far as I remember, 30 years or so in the internal audit profession. And it's just not gained the traction that I think it was expected to over the years. And in part because of what we just saw, is that the control self-assessor is someone who's drawn from the crowd, who may have availability to assess controls, but not necessarily have the expertise to assess certain controls. Whether they have, a perspective on customers and revenue and operations as it may relate to revenue-related controls, or picking an area that's very routine and testing controls like payroll, where, again, I go back to that. It's not really that strategic. It's vital that you have sufficient payroll controls, but is that really where your risks are? So I think what I've seen is organizations create a control self-assessment in order to be able to reduce their cost, maybe reduce the surprises. But when you have an independent assessor who has more of a deeper risk and controls mentality, is they begin to ask more questions around, well, why are we even doing this control? And how often is this control performed? Does it make sense that it's performed as frequently as it is? Therefore, it's costly. Is the design of this control really the most effective design that we should have for this control? So control self-assessment is really important. I think those questions that Eloise was posing there around the design and does it address risk is fundamentally important to whether control self-assessments will gain traction. And then also that there's an individual who has a deeper controls on and risk understanding who's monitoring the inputs from these control self-assessors. I mean, that's where there's this break between we have control self-assessment, but the independent assessor's coming up with a slightly different answer, or sometimes a drastically different answer. Just if I can go on. So that daycare operator, they had controls in place to evaluate criminal background checks. And they had control self-assessment of those background checks. But the new CEO, from his background, was saying to himself, I don't trust these results. Our criminal background check process is not as robust, nearly as robust as it should be. We should have a zero defect policy as it relates to criminal background checks. And so he had asked myself, as the internal audit director, to help them evaluate this. And what we found were lots of errors. And so what we did was we helped to kind of recast the program, provided templates for how these daycare operators should be testing their controls. And what we found in the course of about a year is that the results changed dramatically. The zero defect policy was working. There were errors. And consequently, where there were errors at certain daycare operators, those people were fired. And that the zero defect policy was put in place because the CEO wanted to, he had this risk idea that I can't have any errors in background checks. Heaven forbid that we have a pedophile in a daycare center.
Mm-hmm.
And so we just can't live with that risk. Zero. We can't live with any of it. And so over time, within about a year, we helped to recast this self-assessment program.
Okay, so when you have a control self-assessment that is not, it's kind of compliance oriented, but you have an auditor, be it internal or external, that has more of a critical view on the business itself, you get that gap, right? Okay, why do you have the control? Why don't you have this other control, right? But if you have the scenario where control self-assessment is compliance oriented, but the auditor is also compliance oriented, you won't have that gap, right? You won't have that gap that instigates action. How can you assure that the audit or the auditor, especially when we're talking about like external auditor, will be driven by like business view and not just, compliance? How can you make sure of that?
Well, I think the flaw there can be relying on the external auditor and their evaluation of controls is only a narrow slice of the whole pie. Is that, they're only looking at financial reporting risk. And there's all kinds of operational reporting that are fundamental to evaluating how the company is operating. And so they're not looking at any of that operational reporting and the integrity of that reporting. So you're only getting a very limited amount of assurance from the external auditor's view on risk. And the same goes with internal audit too, is that certain internal audit functions are heavily focused on Sarbanes-Oxley compliance, maybe, and not really focused on operational risks. And that's not their mandate. But unfortunately, that's where surprises happen within businesses. So why this difference between the control self-assessment results and the auditor's results, depends upon, is this control self-assessment program designed to help us enhance our risk management process? And so you have to really start with, where are our risks? Do we have controls to mitigate these important risks? And how are we instituting this control self-assessment program to evaluate those important risks? And then to periodically step back and say, are we testing the right controls here to evaluate these risks? So it's more than just this compliance effort to test controls. You have to take the results periodically and refresh those results, refresh the mindset, evaluate why we're doing these in the design, and getting the right people as part of that conversation.
Okay. And John, I'm going to make this question a 2-in-1, right? what does a control self-assessment program look like when it's genuinely working? It's continuous, it's owned, it's connected to remediation. So what does a good control self-assessment program look like? And how do you think this will evolve as organizations become more complex and interconnected? How is this going to evolve in time, right?
Well, control self-assessment will have to be something that is more successful than it's been in the past. The use of probably AI, where Eloise had just briefly demonstrated that, is something that's important to this process too, in helping the control self-assessor and the person who's evaluating the results drive a better result. Where I'm seeing it work, and it's sort of evolving, is one of my clients is asking me to reduce my participation in Sarbanes-Oxley, to have people internally begin to test their controls because of the cost of me, the external consultant.
Mhm.
And so one of the complaints that was put up by an individual who's testing revenue controls is that he asks too many questions. And I said, that's not a bad place to be right now. Is that control self-assessor is trying to develop his understanding of what's going on within each of these business units. There's 7 business units. And so how is the revenue process different? How are customers different? The product that we're selling different? The sales terms different? And so he's developing this deeper understanding of the operations as well as just testing the integrity of the revenue recognition control. And so that mentality, they have the right individual testing those revenue controls if he's asking a lot of questions that don't necessarily drive the result of that control self-assessment for revenue recognition, but he's creating a much greater awareness for what's going on in this business and what's changing. How are our customer demands on delivery changing, which changes your revenue recognition policies. So that is a place where it's probably going to succeed because they have the right individual asking lots of questions.
Okay. Makes sense. So John, thank you very much for your collaboration. If you want to make some final remarks, like what's the takeaway you would like people to have from this conversation? And before you do that, I'd like to thank everybody and ask them to take a couple of minutes here in the end to fill out our feedback form that is on the chat, okay? So John, what's the takeaway?
I think control self-assessment is something that has to work because I see too many of these are my clients, and this is not the entire world, but the responsibility for controls cannot be placed just on the shoulders of the accountants. Is that there have to be other individuals who are responsible for controls to mitigate risks. And that because it just seems like every company that I'm dealing with are constrained, large companies, smaller companies, is that control self-assessment is something that has to be properly established with the right people and with some mix of independent assessment periodically in order for it to really drive risk management goals.
It has to have a conjunction of people involved, and it's not just something that you delegate to and think it's going to work by itself, right? It requires
Exactly.
expertise view on it as well, right?
The collaboration is control
Yeah.
self-assessment is not a one and done, one individual. It's a collaboration. It's conjunction, as you just said, of individuals.
Perfect. Thank you, John, again for sharing your experience and your knowledge with us. It's always very rich and
Thank you.
interesting. And thank you all for participating. Hope I see you on the next webinar.
Great. Thanks, Guilherme.
Bye.
Take care. Bye-bye.